Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster, your host of the Northbound Wealth Podcast, weekly market insights. Markets shrug off chip worries, finish strong last week. Stocks bounced back last week as enthusiasm for the AI trade continued as rumors of a Middle East peace deal agreement bolstered investor optimism. The S&P 500 advanced 0.88%, its eighth straight week of gains, while the Nasdaq Composite Index edged ahead 0.45% in its seventh straight week of gains of the last eight. The Dow Jones Industrial Average climbed 2.13% to another record high. The MSCI EAFE Index, which tracks developed overseas stock markets, rose 2.16%. So it's the S&P 500's eighth winning streak. That's eighth week. The S&P 500 ended Friday's session at 7,473.47, close to the record closing high it reached last week of 7,501.24. This marks the longest weekly winning streak since a 9-week run that ended in December 2023. The index is now up 3.7% for May and has climbed 9.2% in 2026. Government data this week showed U.S. housing starts decreased less than estimated in April amid a jump in multifamily projects, while the single-unit component declined. Separate data from the National Association of Home Builders and Wells Fargo also showed U.S. home builder confidence unexpectedly rose in May despite elevated mortgage rates, macro uncertainty, and continued affordability challenges. U.S. consumer sentiment, however, declined to a fresh record low in May amid fears that high gasoline prices could erode purchasing power, the University of Michigan said Friday. The main sentiment index tumbled 10% to 44.8 last month. The consensus in a Bloomberg-compiled poll was for May's print to stay unchanged from a preliminary 48.2 estimate. The healthcare and utility sectors led the gainers this week, climbing 30.3% each, followed by a 3% boost in real estate, a 1.9% gain in consumer discretionary, and a 1.6% rise in financials. Technology and industrials and materials also edged higher. Dexcom had the largest percentage increase in healthcare, jumping 17% on the week. The company announced the launch of its Dexcom Flex, a continuous glucose monitoring system for adults with type 2 diabetes who are not using intensive insulin therapy in Germany. The utilities sector's top gainers included shares of Dominion Energy, which unveiled an agreement to merge with NextEra Energy in an all-stock deal to create the largest regulated electric utility in the world. Dominion shares will receive 25.5% stake in the combined entity, while NextEra's shareholders will own about 74.5% of the merged company. Dominion stock climbed 9.6%, while NextEra, the only weekly decliner in the sector, lost 5.2%. Communication services fell 1.9%, while consumer staples shed 1% and energy edged down 0.4%. The hardest hit stocks in communication services included shares of Take-Two Interactive, which fell 6.1% on the week. The company posted a narrower than expected fiscal fourth quarter loss on higher than expected revenue, but its fiscal 2027 guidance came in below analysts' mean estimates. Kevin Warsh was sworn in as the new Fed chair, while investor enthusiasm over the AI trade and other tech stocks added to the market's ebullient statement. As Kevin Warsh takes over as Fed Reserve Chair with his own goals, he may face challenges even beyond rate policy, from inflation to independence to a bulbous balance sheet, per a Charles Schwab article by Dan Rosenberg. I'll go over that later in the podcast. So how are we doing? Let's see. Over the last year, okay, so 12 months ago to now, the Nasdaq's up 13.39%, S&P's up around 9.27%, Dow Jones is up 5.26%, MSCI EAFE is up 7.68, so looking good across the board. 10-year Treasury is sitting around 4.56%. That's up about 6% from a 4.3% print about a month ago and about 13% higher 3 months ago. We were about 4.03%. Thank you, Y-Charts, for that information. Fed meeting minutes. So the Federal Reserve released minutes from its April FOMC meeting, Jerome Powell's last FOMC meeting as Fed chair. In the minutes, he revealed that if the Fed were to adjust rates sometime during the remainder of this year, it might be a rate hike rather than a rate cut. All right. Obviously, he's pointing to inflation on that. Key economic data, Case-Shiller Home Price Index, consumer confidence. That's Tuesday. Thursday, weekly jobless claims, new home sales, and durable goods. Friday is going to be GDP, or gross domestic product, personal consumption, or the PCE index, trade balance in goods, retail and wholesale inventories. And then notable companies reporting earnings this week. Wednesday, we got Marvell Technology, Salesforce, and Synopsys. Thursday, Costco, which is, I feel like everybody goes to Costco. And then Dell Technology. So we'll get a read through to the consumer with some of those reportings. All right, tax tip of the week. Think about credits and deductions now to prepare for your filing. Here are a few facts about credits and deductions that can guide you through your year-round tax prep. Taxable income is the amount remaining after someone subtracts eligible deductions from their adjusted gross income, including the standard deduction. Some taxpayers may itemize their deductions. The Tax Cuts and Jobs Act changed itemized deductions. In comparing these changes, many individuals accustomed to itemizing may find it more beneficial to take the standard deduction. Generally, if a taxpayer's itemized deductions are more than their standard deduction, they should consider itemizing. Taxpayers can subtract tax credits from the total amount of tax they owe. To claim a credit, taxpayers should keep records demonstrating their eligibility. Some tax credits include the Child Tax Credit, the Child and Dependent Care Credit, and the American Opportunity Credit or Lifetime Learning Credit, and the Earned Income Tax Credit. This information is not a substitute for individualized tax advice. Please consult with a qualified tax professional to discuss your specific tax issues. And this tip was adapted from irs.gov. Stay tuned for the next segment. Got a good show for you. There's a piece out there written by Dan Rosenberg on May 18th on markets and the economy. And this has to do with the Federal Reserve Chair, Kevin Warsh, who takes the helm of the Federal Reserve Board. So he wrote an article, and I want to make sure that everybody's aware of where Charles Schwab stands, at least a representative from there. As Kevin Warsh takes over as Federal Reserve Chair with his own goals, he may face challenges even beyond rate policy, from inflation independence to a bulbous balance sheet. So he arrives in Washington with a laundry list of changes that he wants as Federal Reserve Chairman. He might struggle to achieve them anytime soon or at all, facing possible backlash from other policymakers and a deep foundation of institutional tradition. Reducing interest rates from the current range of 3.5% to 3.75% is probably the goal of most often associated with Warsh. But with inflation still elevated, that may be his biggest challenge. Quote, "We assume he'll try to have a lower rate bias, but inflation above 2% will make that difficult," end quote, said Colin Martin, head of fixed income research and strategy at the Schwab Center for Financial Research. Several other goals stand out, including reducing the size of the Fed's balance sheet, changing how the Fed communicates, and possibly most important, convincing the market he's independent from President Trump. Lighter rates, a heavy lift. So, in April's FOMC meeting chaired by outgoing Fed Chairman Jerome Powell, 4 policymakers dissented from the FOMC's decision to pause rates between 3.5% and 3.75%. Of those, 3 weren't against the pause, but instead opposed what they called the FOMC's bias towards easing rates with inflation, surging amid a war-fueled oil rally. Inflation is above 3% annually, and the Fed's inflation goal is 2%. The dissents could represent an acknowledgement that the risks to higher inflation are greater than the statement implies, Martin said. With inflation above the Fed's 2% target for 5 years and counting, the committee can't be complacent. Warsh, a hawk when he's served on the Fed during the great financial crisis 20 years ago, became more dovish over the years. He thinks the Fed can keep rates lower based on AI-driven productivity improvements. The AI boom is the, quote, most productivity enhancing wave of our lifetimes, past, present, and future, end quote, Warsh said. According to a recent New York Times article, he called AI structurally disinflationary. This theory triggered debate about whether the Fed could let the economy safely run hot under an AI driven productivity surge by lowering rates. Not all Fed policymakers share his views. I expect that the AI boom is unlikely to be a reason for lowering policy rates, Fed Governor Michael S. Barr said in February. Barr was one of the 8 FOMC members voting to keep rates paused at the April meeting, with 8 members voting to pause and 3 others opposing any sign of easing bias. It seems unlikely Warsh can change the paradigm right away, barring some sort of massive collapse in unemployment. It's a reminder to Warsh that the most important letter in the FOMC is the last one, C, for committee, said Michael Townsend, managing director of legislative and regulatory affairs at Schwab. As of May 15th, the CME FedWatch tool shows almost no chance for a 2026 rate cut, and after the recent bearish April CPI and producer price index, it factors in much higher chances of inflation fighting rate hike versus lowering rates. This would be an ironic turn if that's Warsh's first move after he stressed the need for rate cuts. His challenge intensified with news that Powell plans to stay on the board, meaning the former Fed chair will continue to have a vote on rate policy. That makes Warsh the first new Fed chairman in more than 70 years to inherit an active predecessor. Powell promised he'll keep a low profile, but any public remarks he makes arguably carry more weight than the words from any other Fed policymaker besides Warsh himself. Powell's decision to stay also means the exit of Fed Governor Stephen Moran, who voted several times to lower rates. That's another important facet of this looking ahead, is that the Uber dove is now not a member of the Fed anymore, said Liz Ann Saunders, chief investment strategist at Charles Schwab Research Institute. Cutting the Fed's balance sheet. So the balance sheet is somewhat esoteric and more of a background buzz than a headline maker. That said, it can affect rates, and Warsh's hopes of taking a knife to it may raise resistance. The Fed's quantitative easing, or QE program, following the Great Recession and again after the pandemic, added trillions of dollars to the Fed holdings in hopes of keeping rates down and stimulating economic growth. At its peak in 2022, the balance sheet reached almost $9 trillion before falling to around $7 trillion by the beginning of May of 2026. This gradual diminishment, or quantitative tightening, was an effort to ease inflation when it surged in 2022 and 2023, but the balance sheet remains well above 2010 levels, near $4 trillion and under $1 trillion as it sat at before the 2008 financial crisis. It's off its recent high as a percentage of gross domestic product, or GDP, but remains elevated by historical standards. The balance sheet mainly consists of financial securities that the Fed buys and sells in the open market. When it adds longer duration securities to the balance sheet under QE, Treasury yields can fall, reducing corporate and consumer borrowing costs. When it reduces holdings, yields tend to rise, but it's a delicate balance. Sometimes the signal is more important than the actual implementation. Warsh wants to see the balance sheet fall, saying it gives the Fed too much presence in the financial markets. He called it bloated in 2025 Wall Street Journal opinion piece, but shrinking it too quickly might trigger market volatility by causing bank reserves to decline. Even during the recent shrinking, the Fed last year had to commit to buying $40 billion a month in Treasury bills through April to keep the reserves ample. This was in hopes of avoiding a repeat of 2019 when volatility surged in the so-called repo or repurchase agreements market, where the Fed provides temporary liquidity to banks and other lenders. Warsh has long been a proponent of a smaller balance sheet, Martin said in a recent On Investing podcast. If the Fed were to reduce its holdings of treasuries, that could send yields higher and new buyers would need to step up. That would go against the current administration's preference for lower yields. From comments that Warsh made in his Senate Banking Committee confirmation hearing last month, he knows he can't make an immediate impact on balance sheet goals. What's important is that Warsh mentioned that it'll take a lot of time and it should be well communicated, Martin said. He also said something along the lines that what was done over 18 years can't be undone in 18 minutes. So, if there is a plan to shrink the balance sheet, it will likely take time so that the markets don't react or see a pickup in volatility. Shifting communications. So, those who began following the markets over the last 15 years may not realize that press conferences by the Fed chairman after the FOMC meetings weren't always part of the scenery. They only began regularly in April of 2011 under Fed Chairman Ben Bernanke, a tradition continued by Fed chairs Janet Yellen and Powell. The media and investors pay close attention, and the market often moves on the chair's observations. Not everyone is a fan, and Warsh apparently doesn't relish the idea. In his nomination hearing, he declined to comment to holding press conferences after every policy meeting, CNBC reported. Warsh may also want to rein in the number of economic projections the Fed issues. Currently, 4 times a year. Additionally, Fed policymakers frequently speak publicly, but that might be reduced if Warsh has his way. It seems like he really wants to change how the Fed communicates and frequency of communications, Martin said. In speeches and articles, Warsh has said too many economic predictions and speeches by Fed policymakers can make them, quote, prisoners, end quote, of their predictions, which is true, I think. There's pros and cons to all the communications we hear, Martin said. We get a very open look at what everyone's thinking at a given point in time. But then when a given official gives a speech, that can move markets. Now, if we lose that, maybe we focus more on the economic data and our own analysis as opposed to everything they're telling us. In an even more dramatic move, Warsh even discussed having the FOMC meet just 4 times a year instead of 8. I'd be hard-pressed to see an outcome where they only meet 4 times a year, but never say never, Martin said. I don't think it's in the cards. Though Warsh has almost complete control over his press conferences and isn't required to hold any, the dot plot might be harder to chip away. Even an attempt to cut back on his own press conferences might trigger criticism from investors who've grown used to hearing journalists try to pin down Fed chairs on their thought processes. Quote, it has been must-see TV, but I guess we'll get more time back, more time to dissect the statement and such, end quote, Martin said. But who knows? There's just no firm plans yet. There'll probably be a period where maybe it could create some uncertainty and maybe some volatility, given that it's going to be a little bit different if these changes come to fruition, but we'll see. All right, so dot plot targeted inflation changes proposed. Digging deeper into the Fed processes, Warsh seems to have misgivings about the dot plot, a quarterly tool shared by the FOMC mapping out where each policymaker expects interest rates to head in the coming years. The Fed tells the whole world what their dots are going to be, what their forecasts are going to be, Warsh told the Senate Banking Committee at his hearing, according to Barron's. I think if the Fed were to wait until it gets into a meeting before making a decision, that incremental deliberation can keep the bank from compounding its errors, end quote. Dot plot is popular with investors and analysts, however, and there may be some resistance to throwing that away. Central bank transparency has been frequently emphasized since the financial crisis, and the dot plot is an important tool many use to model the future rate environment. In another proposal that may face backlash, Warsh discussed changing how the Fed calculates inflation. What I'm most interested in is what's the underlying inflation rate, Warsh told the committee, according to CNBC, not what's the one-time change in prices because of a change in geopolitics or a change in beef prices. The measures I prefer to look at are things that are called trimmed averages. We take out all the tail risks, all of the one-off items, and we ask ourselves whether the generalized change in prices is having second-order effects on the economy, end quote. Measuring that way might lead to lower inflation numbers than what's out there recently. The counter-argument is that changing calculations to focus on long-term impacts might make it harder to understand shorter-term fluctuations affecting consumers and businesses. So, Independence Day. Last and certainly not least, Warsh faces the challenge of proving he's his own man. He was nominated by President Trump, who's made no secret of wanting rates to fall, and Warsh himself has advocated dovish policy for some time. He's probably the first Fed chair nominee to have a senator ask him if he'll be a sock puppet for a president, something he vigorously denied at his hearing. Warsh told senators he didn't promise President Trump rate cuts in return for his nomination. In fact, he emphasized the importance of the central bank making decisions unharnessed to politics. I've known Kevin since 2003, so a long time, Saunders said. I think he's very smart. I do believe he understands the importance of the independence of the institution. This is Liz Ann Saunders' comment. Even so, if Warsh pushes through rate cuts, he may find himself second-guessed and even face a fresh, quote, sock puppet allegations, end quote. Rate cuts the market doesn't believe in can generate howls of protest from the market in the form of higher treasury yields, making the Fed's job even tougher if economic growth slows in an inflationary climate. If Warsh doesn't want an appointment with a so-called bond market vigilantes, he'll likely have to stick to his promise of Fed independence so long as inflation remains elevated, risking presidential backlash. It's quite a tightrope, as the Wall Street Journal observed in a recent headline, even for a Fed chairman who's anything but a rookie as he arrives in Washington and takes the gavel. So, there you go. There's the update on Kevin Warsh, our new Fed chair, and some observations from Charles Schwab and Co., markets and economics team. And I think they do a great job in covering that space. So thank you for listening. Stay tuned for the next segment. All right, new era at the Fed, what change in leadership means for clients. So a chapter closes. Jerome Powell, Federal Reserve Chair from 2018 to 2026. The length of Jerome Powell's tenure as Fed Chair through a pandemic, the fastest rate hiking cycle in 40 years, and a historic inflation surge and recovery. Few chairs have navigated more. His 8-year tenure. Okay. The chair sets the agenda, leads the debate, but no single person controls the outcome. Every rate decision requires a vote among the 12 members of the Federal Open Market Committee, the FOMC. That's why folks in finance talk about it so much. How many chairpersons have there been in the history? 17, actually, the total number of men and women to have held this role. In the Federal Reserve's 113-year history, the chair does not often change, and each transition carries significant weight for the economy. Kevin Warsh comes in. Warsh joined the Fed board in 2006 at 35 years old, the youngest governor ever appointed. Formerly Morgan Stanley Vice President of M&A, or Mergers and Acquisitions, and Economic Advisor to President George W. Bush. As a voting FOMC member, he participated in every major decision of the 2008 financial crisis. Historical policy stance. He believes the Fed holds rates too low, expands its balance sheet too freely, and overreaches its mandate. He resigned from the Fed board in 2011 over that conviction and returns today inheriting a balance sheet 51.8% larger than when his predecessor began. That was Jerome Powell, that is. A new inflation gauge. Warsh has suggested moving away from core CPE, the Fed's official inflation benchmark since 2000, in favor of trimmed mean PCE, whichever measure the Fed chooses to follow directly shapes how aggressively it moves on rate decisions. Core PCE measures consumer prices, excluding food and energy, the two most volatile everyday costs. Trimmed mean PCE measures consumer prices by removing the most extreme price movements each month, essentially inflation, without the outliers that move it a lot. Fed independence, the precedent that matters, the big picture. In 1982, President Ronald Reagan pressured the Fed chair to cut rates as unemployment neared 11%. Volcker held firm, acting on data alone. Inflation collapsed and the economy stabilized for the rest of the decade. Recent political pressures have raised new concerns over the Fed's independence. So a key takeaway here is a Fed chair who prioritizes stability over political pressure has historically delivered better outcomes for mortgages, purchasing power, and long-term financial plans. Warsh's record and public testimony suggest that his intentions are no different. The current landscape, Fed funds rate and yield curve, the big picture, Warsh takes over with a Fed funds rate of 3.75%, and a 10 2-year Treasury yield spread that spent more than 2 years inverted before returning to positive territory in 2024. Key takeaway here and why that's important is short duration instruments are earning competitive yields today, but those returns reset as rates move. For clients with meaningful fixed income exposure, the shift in Fed leadership marks a moment worth monitoring closely for those of us who are managing money and the yield curve for our clients. Long-term discipline. The big picture is every new Fed chair has stepped into uncertainty and navigated unpredictable circumstances, whether it's Black Monday, the 2008 financial crisis, or global pandemic. The market has eventually come out on top every time. And so looks like Jerome Powell, 2018 to 2026, the end of his term, the performance of the markets was up about 183%. Janet Yellen was about 58% over her 4-year tenure from 2014 to 2018. Ben Bernanke was before Janet Yellen, 2006 to 2014, 35.8% return. Alan Greenspan, one of the longest or the longest tenured, 1987 to 2006, he had a performance of positive 284.0%. Paul Volcker, 1979 to 1987, 219.6%. So not bad. I guess you just got to have a long-term perspective. Current Fed Watch probabilities show a 57% chance that rates remain unchanged this year. This reflects uncertainty around Warsh, the decision to even have him in there, compounded by the highest levels of internal FOMC dissent since 1992. Warsh has not committed to holding press conferences after FOMC meetings, stating, I think truth-seeking is more important than reputation, I think truth-seeking is more important than repetition. For markets conditioned to near constant Fed guidance, less communication could mean more volatility surrounding meetings. But there was a long time of history where there weren't that many meetings, and it was great. I kind of advocate for that. Don't need them all the time. And there's some additional information for you as regards to the Fed and the history of the Fed and the chairman and chairwomen that have been in place. All right, stay tuned for the next segment. It's been a while since I've gone over this. The Daily Upside, one of my favorite daily news feeds that I get in my inbox every morning, and really like some of the curated articles that these guys come up with, guys and gals, actually. This one was written by Sean Craig. It's about SoftBank. Go big or go home. AI bets fire up markets as IPOs near. So the Nikkei is quickly becoming the land of the rising Masayoshi sun. The audacious businessman, SoftBank, surged 10.9% in Tokyo on Tuesday to a new record high, while the white-hot stock is now up 46% in the past 5 days of trading, propelled by Sun's, quote, go big or go home, end quote, bets on artificial intelligence. It's a killer strategy. Sun is known as the Ojin Kira, or old man killer. The sobriquet is not as macabre as it sounds, referring to his ability to charm elder tycoons and investors to back his ventures when he's the up-and-coming son of a bootlegger, now 68 years old and a globally influential technology investor tycoon. He's the one founders are looking to charm. Sun founded SoftBank in 1981 as a software distributor, anticipating the personal computer boom that would follow, and ever since has carried out his high conviction, swing for the fences investing approach that makes Mickey Mantle look timid at the plate. Over the years, Sun's ambitions led the company to play a role in the seemingly every development in the internet's modern trajectory. There are search engines where SoftBank helped set up Yahoo, Japan in pre-Google 1990s. There's home broadband where it began widely distributing modems to customers in the early 2000s. There was getting in on the ground floor of China's internet economy by investing in Alibaba in 2000. There are smartphones, where SoftBank set up a mobile unit in 2006 and first brought the iPhone to Japan 2 years later. Sun's record, however, is not without a black eye or three. He set the record for the biggest fortune lost during the dot-com bust since broken by Elon Musk. There were regrettable investments in WeWork, Wirecard, and Greensill, and his two massive Saudi-backed vision funds have posted mixed results. SoftBank's latest rise comes as Sun has again positioned the firm at the tech vanguard, betting that huge AI gambles will pay off. For example, SoftBank is one of OpenAI's top shareholders, having built up a $64.6 billion stake, 13% stake. That's about 13% of the ChatGPT maker. Reports suggest OpenAI plans to soon file for an IPO, turning what have so far been paper gains for the SoftBank into liquidity. SB Energy, another portfolio company with significant exposure to the AI trade, is also plotting an IPO in the US. The energy infrastructure provider received $1 billion in commitments from SoftBank and OpenAI earlier this year as part of the massive $500 billion Stargate project. Du Japon La France. SoftBank sold its entire $5.8 billion stake in NVIDIA last year to fund its bets on OpenAI and Stargate, a US-based joint venture that also includes Oracle and Emirati investments firm MGX. Not one to stop there. Sun is reportedly considering another massive national AI infrastructure investment worth up to $100 billion, this time in France. Thank you, Sean Craig, for that little snippet. Next, they wrote about energy and about Exxon. Brian Boyle wrote this piece. Exxon pours billions into meeting rebounding carbon capture demand. So Exxon hopes to profit by taking back some of what it helps put out into the world. For the oil major, one of the world's biggest corporate emitters of greenhouse gases, that means sucking in those very same emissions. The company is now investing billions to build out a vast infrastructure for carbon capture and storage, CCNS. According to the Financial Times reported this weekend, it's a sign that the once hot yet heavily contested carbon credit economy might be making a comeback. And yes, it is driven in part by the artificial intelligence boom. It's not so easy being green. One study projects that the AI rollout could contribute as much as 44 metric tons a year of additional carbon emissions from 2024 through 2030. Since the big tech firms behind it still maintain a pretense of climate consciousness, a new tailwind is formed for the carbon capture and storage industry. That's an opportunity for Exxon, which the FT said it's expanding and connecting customers to its 900-mile network of underground carbon transfer pipelines. Who knew? If it feels surprising or unexpected to read the words carbon capture in 2026, it should. Investment into the technology as well as into the carbon credit economy writ large has been abetting more than flowing recently, though Exxon's push is just one of several signals that the revival may be on the horizon. Corporate purchases of carbon credits last year fell to the lowest level since 2020, according to the Bloomberg NEF data. Meanwhile, global investments in CCS technology came in at $6.6 billion last year, about half the 2023 peak, according to Bloomberg NEF data seen by the Financial Times or the FT. But that was an increase from just $4.1 billion in 2024, with the number of commercially operating CCS plants rising by a third to reach 77, while another 44 plants are under construction. So Brianna Casey said, we see a clear decoupling of market demand from political cycles as corporate action replaces government action in the primary driver of green material or clean electron demand. Carbon capture associate at Bloomberg told the FT. So notes from the underground, of course, carbon credits fell out of favor for a reason, with critics of all political stripes claiming much of the carbon credit market amounted to dubious greenwashing. Exxon, meanwhile, has received local political pushback on its mostly Louisiana-based CCS infrastructure build-out, with some skeptical of the company's plans to sequester the carbon dioxide in deep underground rock formations. Thank you, Brian Boyle, for that. All right, Huawei's chip plans, ambitious or unrealistic? Jamie Wild wrote this little piece, and I really like it, want to share because it's interesting. I recall that when Trump first got into office in 2016 or so, he had this president of Huawei, this lady, arrested in Canada because they were caught spying on Americans and through data centers and mirroring. So it was interesting to see this article pop up as a harken back to 2016 days in my brain. Even semiconductor chips seem to be on the GLP-1s now. The Huawei announcing Monday that it'll launch an ultra-thin 1.4 nanometer chip by 2031 using new logic folding technology. Huawei plans to first use logic folding, a process of folding and stacking circuits to shorten chips wiring to make its Kirin smartphone chips this fall. In the semiconductor world, thinner means more powerful. Currently, China's most advanced chip-making abilities are believed to yield 7 nanometer chips. Taiwan's TSMC, the leader in chip manufacturing, makes 2 nanometer chips with a plan for 1.4 nanometer chips in 2028. The chip queen ditches Moore's law. So Huawei's Hai Tingbo, who's known in tech circles as the chip queen, is leading Huawei's semiconductor biz through a stage it describes as extreme survival mode. The Chinese company was blacklisted from receiving advanced semiconductor technology in 2019 due to national security concerns. That left an NVIDIA-sized hole for Huawei to fill. But it also left Huawei without much of the tech it needs to make advanced semiconductors, including key lithography equipment. He thinks Huawei can compete on a global scale despite the restrictions. During a semiconductor symposium, in air quotes, in Shanghai on Monday, he talked about Tau scaling law. It's Huawei's answer to Moore's law, which claims the number of transistors in a microchip will double every 2 years while costs halve. NVIDIA CEO Jensen Huang is known for saying semiconductor development is outpacing the doubling timeline of Moore's law. The Tau scaling law dispenses with the measure of progress that Moore's law sets altogether. Instead of doubling the number of transistors, the law of Tau basically measures data transmission speed. Focusing on improving this metric with logic folding could help Huawei improve chips without relying on the latest lithography equipment. Wait and see. So, stack design, like the ones made by logic folding, can make chips hotter. Keeping chips cool is a major cost for tech companies and why data centers use so much water. That's all to say there are hurdles ahead for Huawei. Concerning Huawei's 2031 timeline, Chris Miller, author of Chip War, The Fight for the World's Most Critical Technology, told the Daily Upside, we shouldn't believe it until we see it. So, Jamie, thank you for that. And some extra upside they always have in their daily emails. A word from the pontiff. Pope Leo warned that AI could be the new Tower of Babel, calling for it to be, to quote, disarmed and taken out of the hands of the military and financial interests. Teen troubles. A job placement agency predicts that U.S. teens will snag only 790,000 jobs this summer, the lowest on record. Turn up the volume. Evercore ISI analysts find that Kalshi and Poly market contracts with a high volume of trading and short termination dates produce the most reliable probabilities. So if you happen to be in the betting markets or the prediction markets, take note of that. All right. Thanks, Daily Upside, for that piece. And I hope you guys have a great week and weekend. We'll talk about markets again next week. Thanks for tuning in. Like and subscribe. Take care.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.